The price to sales ratio, or PS ratio, sometimes used by investors when making decisions to buy or sell shares. How to calculate the price to sales ratio? When would you use the price to sales ratio rather than the price earnings ratio? And what do investors use the price to sales ratio for? Let's start off with the calculation of the PS ratio. The price to sales ratio equals the current market capitalization of a publicly traded company divided by its latest full year revenue. The essential question you are trying to answer is, how much are investors willing to pay per dollar of revenue? For example, if we do an online search for the market capitalization of Snap Inc. at the time of making this video, we will find that it is $17.2 billion. The latest full year revenue of the company is found in the company's income statement or P&L. The revenue number is $4.6 billion. Divide market capitalization by revenue and you get to a price to sales ratio of 3.7. Alternatively, you can calculate the price to sales ratio by taking the share price and dividing it by the revenue per share. Both in the numerator as well as the denominator of the calculation, you divide by the share count. A share price of $10.88 divided by revenue per share of $2.91 gets you to the same price to sales ratio of 3.7. Or if that's too much work for you, use a stock tracking website like Simply Wall Street and have them retrieve the data and make the calculation for you. Same outcome. Market cap of $17.2 billion divided by $4.6 billion of sales gives you a 3.7 PS ratio. The cool thing about Simply Wall Street is that they always provide the most up-to-date numbers. Market capitalization is continually refreshed, and the revenue is either based on the latest financial year or what is called trailing 12 months revenue. For example, if you consult the Simply Wall Street site in November, the revenue number of the latest 12 months from last year's Q4 through this year's Q3 will be used, which saves you the job of adding up quarterly revenues manually. Why would an investor look at the price to sales ratio rather than price earnings ratio? Wouldn't the price earnings ratio give you a more complete picture, as it includes information on the company's margins and not just its sales? Well, let's try to calculate the price earnings ratio for Snap Inc. The price earnings ratio also takes market capitalization as the numerator, so the same $17.2 billion we retrieved earlier. In the financial statement called the P&L or the income statement, we now take the bottom line, net loss, rather than the top line, revenue. The net loss was $1.4 billion in the latest financial year. The outcome of taking $17.2 billion market capitalization and dividing it by negative $1.4 billion in earnings is NMF, not meaningful. For the price earnings ratio calculation to work, both the market capitalization as well as the earnings need to be a positive number. In this case of a company making a loss, and or in the case of a company growing very rapidly in revenue, investors tend to turn to the price to sales ratio as an indicator of relative value between companies. The price to sales ratio is particularly popular in the technology sector, which tries to position itself as young, hip and high growth, and argues that the price earnings ratio might be useful for dinosaurs, but not for the up-and-coming superstars of tomorrow. Back to the price to sales ratio. The price to sales ratio in isolation is not necessarily interesting. It gains analytical strength when used in comparison. Courtesy of Simply Wall Street, here is the first comparison you could make. If you believe that Pinterest is a relevant peer or competitor to Snap Inc., you could compare the 3.7 price to sales ratio of Snap Inc. to the 7 price to sales ratio for Pinterest. This might provide a clue that Pinterest could be overvalued and potentially lead you to sell, as its price to sales ratio seems relatively high, and Snap Inc. could be undervalued and potentially lead you to buy, as its price to sales ratio seems relatively low. Rather than just doing a one-to-one comparison to a single competitor, it might be better to compare to the industry average. For the US interactive media and services industry, The average price to sales ratio at the time of making this video is 1.6. That makes the 3.7 price to sales ratio of Snap Inc. relatively expensive and would suggest that it might be a time to sell. Or if you have had your eyes on Snap Inc. shares for a long time now, maybe even since its IPO several years ago, you could compare the current price to sales ratio of 3.7 to historical levels that went up as high as 30. You heard it right. There was a time when investors were willing to pay 30 times revenue for Snap Inc. The current price to sales ratio of 3.7 is the lowest PS ratio in years. But nobody knows for sure whether it will go back up, stay constant at the current level, or continue to drop in the years to come. The price to sales ratio provides a data point that could be useful in your review of a company. But please, don't let this be the sole criterion that you base investment decisions on.